Passive Pockets is presented by Equity Trust. Last week, Donald Trump announced sweeping new tariffs impacting imported goods from most of the world's nations, and there's already been intense economic fallout. Are we entering a new economic era? Is this just inflation by another name, or is it one of the largest tax hikes in history? And what can LPs do to protect themselves right now? Welcome to Passive Pockets, the passive real estate investing show, brought to you by Equity Trust. I'm your host, Jim Pfeiffer, and today I am joined by Jay Scott, investor and author, to talk through the Liberation Day tariffs, the economic ripple effects, and what passive investors should be watching right now. Let's get into it. Jay, thank you so much for coming on. Today we're going to be talking all about tariffs.
I appreciate it. Thanks for having me, Jim.
Liberation Day was last week when Trump announced these tariffs. He's calling them reciprocal tariffs. Can you go through why that isn't exactly true and what these tariffs really are to start? Just lay a base for us.
Real quick, at its most basic, a tariff is basically a tax on businesses and people that import stuff into a country. So when the U.S. puts on a tariff on, let's say, Chinese automobiles, that means that anytime somebody in the U.S., a business or a person, tries to import a Chinese automobile, in order for Customs and Border Patrol to release that import into the country, they need to be paid that tariff. So a tariff is paid by the country that, or the people that are importing. So it's essentially a tax on imports and businesses that import. And so historically, other countries have tariffed us, probably more than we've tariffed them. Not in all cases. A good example is, for example, we have in the U.S. 100% tariff on Chinese electric vehicles. And we do that for a very good reason. We don't want Chinese electric vehicles to compete with our electric vehicle market in the U.S. And so we make it more expensive to bring Chinese electric vehicles into this country. Other countries do the same thing. They have tariffs against us. They have tariffs against other countries. And basically, they use that as a way to make it more expensive to bring foreign imports into the country than potentially it is for them to domestically manufacture those things. And so that way they can boost domestic manufacturing. That way they can boost domestic businesses and cut down on the amount of importing of foreign stuff that's being imported. And so we can talk about whether that's good for us to be doing as well, or if it's better for other countries to be doing it. But in general, that's what a tariff is, and that's kind of the purpose of a tariff. What was discussed over the last couple of weeks by the current administration, and let me be clear, I don't want any of this to be partisan. I can disagree with the economic policies of a president or an administration or a Congress without it being, I hate that person or that administration or that group of people. I'm fairly critical of every administration. I'm not a big fan of any politician. So let's just be clear that I try and keep anything personal out of this. And it's basically, this is just a reflection of my economic beliefs and the logic behind my beliefs. So a few weeks ago, or maybe even a few months ago, the president made the claim or made the point that other countries tariff us more than we tariff them, and that it's unfair. And we can talk about whether it's unfair or not. At the heart of it is, the claim was it's unfair, and the only way to make it fair is for us to be tariffing other countries the same amount that they're tariffing us. Or maybe trying to convince other countries to stop tariffing us and we stop tariffing them, and then we're at the same amount anyway, zero. You mentioned Liberation Day last week. That's when we basically announced the tariffs against other countries. The expectation was that we were going to see parity in tariffs, reciprocal tariffs. If one country tariffed us 20%, we would tariff them 20%, et cetera. Instead, what we saw was a set of tariffs that was based on trade imbalances. And what that means is, imagine a country, I'll just make up a fictitious country, imagine a country where we import $2 billion worth of their goods, and they import $1 billion of our goods. So basically, they're importing twice as much of our stuff than we're importing of their stuff. Now, maybe neither side has any tariffs. The way that the reciprocal tariffs were calculated last week for Liberation Day was the government said, we are importing this much, and the total imbalance, in this case, the imbalance was $1 billion. We're importing $1 billion less than they were. And then the total imports was $2 billion. So you divide that $1 billion imbalance by the $2 billion total imports, and you get this 50% number. And so the government said, okay, they are quote unquote tariffing us 50%. We're going to be nice and we're only going to tariff them back 25%. But in reality, it had nothing to do with tariffs. Like I said, in this example, there may have been zero tariffs either way. That 50% was a reflection of the trade imbalance, the fact that we were importing more from them than they were importing from us. And so that kind of begs the question, does the government care as much about reciprocal tariffs or other countries' tariffs as much as they care about the fact that we have a very large trade imbalance? We import a whole lot of goods from around the world and we don't export as many goods. And so what this math and these reciprocal, quote unquote, reciprocal tariffs indicated to us last week is it may be less about the tariffing and more about basically the fact that we have this trade imbalance and we're trying to solve the trade imbalance as opposed to actually trying to solve the unfair tariffing.
Right. And in your opinion, is there like the trade imbalance, is that good, bad, or it just is? Because I think mostly what we export, the United States, are services, right? And then we import goods. And there is an imbalance. But what does that do to the dollar and to the economy if we're trying to get everyone to be balanced? I don't know that makes sense, does it?
Warren Buffett has my favorite quote on this, and he says, I have a large trade imbalance with my dentist. I pay my dentist a lot of money. My dentist never pays me anything. And I think it's a perfect analogy here because that's essentially what we have in the U.S. We pay a lot of money to other countries to import their stuff, and they don't pay us nearly as much. Just like with your dentist, it's okay because you are getting fair trade in return. You're getting dental services, you're getting braces, whatever it is. Likewise, on a global scale, we are getting services and goods in return for all that money that we're putting out. And so personally, and most economists would agree with me, having a trade imbalance isn't inherently bad. In fact, I'm going to take it one step further. The U.S. has the world's reserve currency. That means that most trades, most transactions that happen on this planet happen in the U.S. dollar. And this was an agreement that the biggest economies in the world made back in the 1940s, that the U.S. was going to have the world's trade reserve, the world's currency reserve. The U.S. dollar was going to be that currency that everybody used around the world. And so one of the reasons, probably the single biggest reason why we've become the greatest superpower on this planet is because we have essentially full control over all the currencies on the planet. Every other currency on the planet is pegged to ours. We could strengthen or weaken every other currency on the planet just given the benefits we have as the world's reserve. And so maintaining the world's reserve currency is extremely important. It's basically the difference between us maintaining world supremacy, both economically, geopolitically, militarily, and losing that to somebody else. And so maintaining the world's reserve currency is probably the single most important economic thing that the U.S. should be thinking about. And the best way to do that is to ensure there are more U.S. dollars out there in the world to be traded. So when we import $1 billion worth of stuff to China, what we're really doing is we're exporting $1 billion US to China. We are giving them $1 billion. What does China do with that $1 billion? They might do a few things. One, they're going to trade with it with their other partners, so they're going to make the US dollar kind of work around the world. That's great. Two, if they get too many dollars and the balance of currency in their central bank is off, they're going to have to get rid of some of those dollars in other ways. The big way they do that is they buy our treasury bonds. They buy our debt. We love the fact that other countries buy our debt. That's good for us. It allows us to issue more debt at lower rates. China's a big buyer of our debt, and mainly they use the dollars that we export to them when we import stuff. Third, if they don't want to buy our debt, a lot of times they'll use those US dollars to make asset purchases in the US. They might purchase business stakes. They might purchase real estate. They might purchase other things that benefit the U.S. because it helps our asset values. And so exporting U.S. dollars, having a large trade imbalance, it may seem unfair that we import more than we export, but the reality is the benefit it provides us in maintaining the world's reserve and keeping the U.S. dollar moving throughout the world on a transactional basis much, much, much outweighs the downside of having a big trade imbalance.
I want to also talk about targeted tariffs versus broad-based tariffs, because this is very broad-based tariff. And we learned certainly during COVID and the pandemic that we want to have some things manufactured here, right? For our national security and for many other reasons. But having broad-based tariffs does it accomplish that, I guess? You had mentioned that in a previous conversation we had that targeted tariffs sometimes make sense, but these broad-based ones sometimes don't. So can you go to bat with that for us?
I mean, we've had what are called targeted, or what are referred to as targeted-based tariffs for over a century. And a targeted-based tariff is basically the president or Congress, normally it's Congress, saying, hey, there is this specific product or the specific service or the specific sector or industry that's really important that we be fostering here at home domestically. And maybe it's important because we think we can build things more efficiently than we can import. Or maybe it's important for national security. So, for example, medicines, pharmaceuticals, really important that we have some domestic manufacturing capacity here in the U.S. because if something happens like COVID and we can't get our hands on medicine for our citizens, that's really bad. Things like technology, chips, computers, from a national security standpoint and from the ability for us to maintain our supremacy as the technological leader in the world, we need to be able to get our hands on that stuff, and we don't want to risk other countries controlling that. So things like chips and technology and electronics, really important that we're manufacturing in the U.S. Things like airplanes, things like weapons systems and weapons themselves, really important for national security. So all of those things, we can use tariffs to encourage U.S. manufacturing. Basically, what we're doing is we're saying, okay, we're going to charge a 50% tariff on a certain medication, which means it's going to cost 50% more for us to get that medication from another country. And that's going to encourage U.S. manufacturers to say, wait a second, it's really expensive to get that medication from another country. I'm going to start a factory here in the U.S. where I can manufacture that for a whole lot less than the cost of importing it with a 50% tariff. We now start making it in the U.S. and we bring prices down. The problem is there are a lot of things in the U.S. that we can't manufacture more efficiently or more cheaply than we can import. So, for example, I mean, let's be realistic. You walk into Walmart and most of that stuff is, for lack of a better term, plastic crap from China. Well, we can get plastic crap from China for a lot cheaper than we can manufacture plastic crap here in the U.S. They have a lot fewer labor laws. They have a lot fewer labor regulations. They have people that will work for a lot cheaper, whether they're forced to or choose to. That's a whole different discussion. But basically, we can buy a straw from China for a tenth of a penny, whereas it might cost a half a penny to manufacture it here. And so it doesn't make sense for us to tariff those products because even if we do encourage American manufacturing, even if we force American manufacturing back in the U.S., what we're going to see is prices are going to go up because it costs more to manufacture here than to import it. And so, yeah, we might be able to force more manufacturing into the U.S. The trade-off is we're going to see inflation. We're going to see prices go up on those products that we just inherently can't manufacture more efficiently than we can import.
You know, you mentioned the dollar and this could possibly weaken the dollar. You mentioned inflation and foreign investment in the global economy. So can we tie it all together? This is a real estate podcast, so we are going to move to real estate shortly, but kind of just tie it all together. Like, what is the goal, do you think, of this? If the dollar is going to be weakened, inflation is going to go up on some or all products, what's the end goal of the administration?
That's the trillion-dollar question, almost literally here. And so I've basically heard 4 reasons why the administration might want to do this. We can talk through them real quickly. So number 1 is bringing back American manufacturing. We just talked about that. Yes, there are certain things that we really should be focused on bringing back to the U.S. Again, pharmaceuticals, weapons, electronics, and chips, things like that we really should be manufacturing here in the U.S. Broad-based tariffs don't accomplish that. Basically, it's a tax on all the other things that we don't necessarily need to be bringing back. There's a reason why these jobs and this manufacturing left the U.S. because we can get it a lot cheaper by importing than we can by manufacturing. So number 1, bringing back manufacturing is a big argument I hear, but I'm not convinced that except with a few specific industries, that really makes sense unless you're willing to put up with a lot of inflation and price increases to force manufacturing back in the U.S. Maybe that's a trade-off that the administration's willing to make and the American people are willing to make, but that's the trade-off, higher prices for more manufacturing. The second reason I hear is that the administration wants to raise revenue. They want to bring in money. So if we can charge I've heard the number $700 billion per year in tariffs, that's $700 billion per year. That's additional revenue that the U.S. has raised that can either be used for tax cuts. It can be used to offset our deficit. It can be used for whatever. Basically, it's $700 billion more than we were making last year because we have these tariffs. Here's the problem. Where's that $700 billion coming from? It's coming from American businesses because those are the ones paying the tariff. And so if the goal is to charge American businesses $700 billion more so that the government can raise $700 billion a year, there are easier ways to do that. Just have a tax hike. Starting global trade wars just to tax our businesses more doesn't make sense. And so that one doesn't really resonate with me. The third one that I'm hearing is we want to negotiate better trade deals with other countries. And this is the one that we've been talking about for the last few weeks, reciprocal tariffs. We want to ensure that other countries aren't charging us in tariffs more than we are charging them. Here's the problem with that one. That's a great goal. And I think it's really important that we negotiate down other countries' tariffs where it makes sense. It doesn't always make sense. We won't go into that now. But there are places where we are being tariffed more than we should, and it's really important that we negotiate those tariffs down. The question is, how do you do that? Do you do it like this, where we impose a huge tariff against them, we cause a global trade war, or do you go in and do it diplomatically? Because the problem is, if the goal of lowering foreign tariffs is for us to be able to export more to other countries to help our businesses here, well, are we really going to accomplish that by pissing off our trading partners? By raising tariffs, we're basically sending the message, hey, if you buy more from us, we could do something stupid in the future while I can impose tariffs again. So what they're thinking is, instead of importing more from us, thanks to these tariffs, they're thinking, how can I go and find other trading partners that aren't going to be as erratic, that aren't going to do these crazy things that are going to hurt us economically? So if the goal is to get fairer trade and fairer tariffs, again, I think it's a great goal. This isn't the way to do it because we're just pissing off our trading partners.
And we're forcing them all to work together without us rather than together with us, right? All of our foreign partners.
So a couple weeks ago, 2 weeks ago at this point, China, Japan, and South Korea came together and said, let's form a regional trade pact. Let's start trading amongst ourselves. This is something that those three countries have resisted for 2 decades now. They've refused to work together. And I think if you would have asked any economist 6 months ago whether there was a high likelihood that Japan, China, and South Korea could all come together to agree on a trade pact, they would have said that's absolutely nuts. And now here we are, and those 3 countries are working together. And lots of countries that are willing to work with China, and lots of countries that are now willing to work with Europe. And so if we find ourselves cut out of these trade deals, it's going to have the opposite effect of helping our businesses do more exporting. It's going to cause our businesses to lose the ability to export. And then the fourth reason that I keep hearing, and this can go deep, I'm not going to go deep on this, but there's talk that maybe the administration is trying to collapse the economy or crash the economy to bring interest rates down. We have got a lot of debt coming due, national debt coming due in the terms of treasury bonds this year, about $10 trillion, somewhere between $7 and $10 trillion. And we have to refinance those bonds at whatever the prevailing interest rate is on that day. And so a lot of people are talking about, okay, crash the economy, bring down rates, refinance all of this debt, and now we're paying less interest on that debt. Long story short, if you do the math on that, we are saving money on the debt. If you can crash the economy and bring interest rates down a couple percent, we might save $150 billion a year, maybe $200 billion a year, which, don't get me wrong, that's a significant amount. But the question is the damage we are doing to our country, our currency, our economy, our relationships with trading partners, is that worth $150 or $200 billion a year? I mean, if we see ourselves in a recession next week or next month or 6 months from now, it's possible we could print $1 trillion in stimulus like we've done the last few recessions. That's going to cancel out 6, 7, 8 years of the savings we're getting by crashing the economy. So I don't think the math works there. So long story short, I think it's clear that this administration has a plan in mind. They have a goal in mind, and they're trying to achieve that goal. But they haven't been transparent with what that goal is. And I think a lot of us are really still in the dark on what they're trying to achieve. And without knowing what they're trying to achieve, it's pretty hard to figure out if they're actually going to be able to get there or not.
It's complicated because they're not transparent, but even a little bit more. they're saying things that aren't, exactly true. Part of that is the tariffs that they're reciprocal and they're not. But we went through that. Now I want to turn to real estate. And you mentioned interest rates and reducing interest rates. The 10-year Treasury is already falling. Can you explain why that is? Because it seems counterintuitive. This will probably cause more inflation. And so then the 10-year drops. How does that all work together?
Let's start with the bonds in general. So Treasury bonds, so if you look at the 10-year, the 30-year, whatever bonds you're looking at, are generally a reflection of expected inflation and growth over that period of time. So 10-year bond is just a reflection of expected inflation and growth over the next 10 years. If people think the country's going to see a lot of inflation and growth over 10 years, those yields are going to go up. If they think the opposite, those yields are going to go down. Historically, what we see from tariffs is it drives bond yields up because tariffs tend to be inflationary. So I mentioned earlier that if we have a 25% tariff on importing automobiles, it costs automobile importers 25% more to bring cars into the country. They pass that cost on to consumers, and we see the cost of automobiles go up by 10, 20, 25%. That's inflation. So tariffs tend to be inflationary, and so normally for a reasonable amount of tariffs, you'll see bond yields go up because, again, they're reflection of inflation concerns or risks. But when you have as many tariffs as we have, when you have broad tariffs that are creating global trade wars and could potentially collapse the economy, at that point, the risk of inflation is outweighed by the risk of lack of growth. The opposite. If we see a major recession, typically when you have a major recession, you don't see a lot of inflation. People don't have money to spend, and so you don't see a lot of price increases because retailers, manufacturers, suppliers can't raise prices during a recession because nobody can buy anything. And so they lower prices, they lower their profit margins. And so what we're seeing now is a reflection of the fact that these tariffs are risking much more than just some inflation. They're risking a major recession. And because people are seeing this as a reflection of recession risk, and because these bonds are a reflection of our feelings on how much the country is going to grow over time, the result is investors feel like we're going to see a contraction, we're going to see the growth in this country stop or slow down, and bond yields are dropping. So I think that's the general takeaway, is that bond yields going down is a reflection of concern over investors that we may be heading into a recession.
Okay, so let's now pivot to real estate, and we'll keep going with the interest rate stuff, right? Because when interest rates go down, real estate investors get excited, especially these days when there's a lot of deals that are in distress, and decreasing interest rates might mean decreasing rate caps on the mortgages that they have on deals that are in trouble. So we'll start there. How does this affect those deals? Is there any positives that might come out of this? So
let me start with, I know the whole reason I'm here is to talk and tell real estate investors out there like what they should expect. And it's a really hard question. I wish I could say this is what I think is going to happen, but instead what I have to say is if we see this, then this is what I think is going to happen. If we see this, because there's a lot of different diverging potential paths depending on where this administration takes things over the next couple months. But in general, I think what you said is exactly right. Short term, there could be a lot of benefits to what we're seeing. As interest rates come down, it's going to take a lot of pressure off a lot of these operators who have been working on deals for 3, 4, 5 years. They're coming up against the end of their loan term if they had short-term debt. A lot of these operators have been in a position where their loans came due a year or two ago and the banks have been negotiating with them to drag the loans out. We may actually get into a position where a lot of these operators can refinance, or the value of properties, because the interest rates are down and their buyers can pay more because their interest costs are less. The values are going up. And so we could be in a situation where short term, there are a lot of benefits for real estate investors simply because rates are going down and allows us to refinance at lower rates. The bigger question is what happens if we have a larger recession? What's the longer term risk? If we see a recession, well, that typically means that we have higher unemployment. People are losing losing their jobs. People are getting their hours cut. People are seeing their wages cut, which means they can't pay as much in rent, or they can't pay as much for a house, or they can't qualify for a mortgage. In general, recessions are not good for real estate. Doesn't mean that we're going to see real estate values crash or anything like that. Most recessions, we don't see that. But what we do see in a recession is that we see a flattening. And we see a flattening in rent growth. We see a flattening in values. We see a flattening in occupancy. We might even see a drop in occupancy. So there are some potential negatives if this kind of short-term downturn turns into a longer-term recession. Again, simply because when we're in a recession, all of our customers, everybody out there, our renters, our buyers, they're our customers. If our customers are losing their jobs and getting their wages and hours cut, that's bad for us.
So let's talk a little bit about commercial real estate versus residential real estate. Meaning there's a lot of different asset classes, but industrial has been super popular recently. There's office, there's retail, multifamily, all these different asset classes. Can you talk a little bit about, and again, I know it's hard to speculate because we just don't know yet, but how different asset classes might be affected by a recession that might be caused by these tariffs?
Investors, the market in general, tend not to like uncertainty. They don't like to know, or they don't like to not know where things are going to be in a month or 6 months or a year from now. And the natural reaction from uncertainty is to sit back and wait. And so one of the things that we are likely to see in general is that there's not going to be a lot of movement unless, again, there's some forcing function like a major recession that forces people to sell because they're losing their jobs. But in general, when you have a lot of uncertainty, you just tend to see a lot of stagnation. A lot of people aren't buying, people aren't selling, people aren't going out and expanding their businesses, people aren't expanding their properties, they're not raising rents, they're not lowering rents. They're just sitting back and saying, I'm going to wait until there's some more certainty in what's going on before I make the next move. So I think the first thing that we're going to see in general is a lot less movement, a lot fewer transactions, a lot less transaction volume overall across all asset classes. That said, this could certainly be an opportunity for specific asset classes. So as we talked about tariffs, one of the potential goals of tariffs is that it encourages domestic manufacturing. If it costs so much to import stuff, it encourages people to build factories and businesses here in the US. And so if you are buying or selling real estate that is likely to be benefited by that boost in manufacturing, that boost in business growth, then you may find that there's some great opportunity to come. You may find that warehouses are going to do well because a lot of businesses are going to start bringing in more inventory and selling them from the U.S. as opposed to drop shipping or keeping inventory overseas. You may find that light industrial becomes very popular because we're going to start doing some light manufacturing. You might find that heavy industrial factories, real estate associated with that might do really well because there are certainly going to be a bunch of companies that say, hey, I'm going to come to the US, I'm going to build chips, I'm going to build cars, I'm going to build whatever it is. And so there are certain segments, and again, I think warehouses, light industrial and heavy industrial, that could be the big winners here. I think it's a little early to make that claim definitively, but those are the sectors that I'd be looking to watch right now.
Okay, so for limited partner investors, again, look at a little bit more industrial, but what else should we be looking at to kind of filter the noise and focus on the data and what matters? Because, we can sit on the sidelines, but, it's hard to time the market. And I think through the pandemic and through, the years we've been, I've tried to slowly keep allocating capital to quality deals with quality operators because I don't know. I can't time the market. So I try to almost dollar cost average my investments. Is that a strategy? Is that a strategy you think people should continue doing? Or perhaps because there's so much uncertainty and this is such a big thing that just happened, should we dial back and maybe wait?
I've been saying both for the last few months. Number one, sitting on cash is not a bad thing. Inflation's still a little bit high, and that's eating away at our cash. But I would rather lose 3% on my cash every year than make a bad investment where I lose 50%. So I'm a big fan of right now sitting on cash, waiting for really good opportunities. That said, don't not pursue opportunities. If you're going to pursue opportunities, be conservative, diversify, dollar cost average, basically do all of those things that Warren Buffett would tell you should be doing anyway. But especially now we should be avoiding taking big risks and going after outsized returns. And so for me, I like things like triple net, where you have long-term stable renters in potentially anchor type stores that you can be pretty confident that they're going to keep paying month after month for the next 5 or 10 years, long enough to get us out of this economic weirdness. So triple net, something I like. I might say that new construction is good. One risk with new construction is that a lot of the material costs when it comes to new construction are going to be impacted by tariffs. One of the nice things that we saw in real estate last week when Liberation Day came around was the president exempted lumber from tariffs. So that's huge for real estate investors. Assuming we don't see tremendous impact on material costs from tariffs, new construction could actually be pretty lucrative. Again, if we're going to see manufacturing moving here in the residential and multifamily side of things, housing starts slowed down a lot last year. We're not seeing a lot of completions, so basically supply is starting to dwindle. So there could be some opportunities both on the commercial and residential side for new construction. Where I would tend to stay away is anything that's expected to generate heavy cash flow. So we don't know if rents are going to drop. We don't know if occupancies are going to drop. If you're looking for short-term cash flow plays, things like flipping houses, for example. Flipping houses may not be a great strategy right now, simply because the short-term impact of everything that's going on is unknown. We could see real estate drop 5% over the next 6 months. And if your flipping margins are 15%, that's a pretty big hit to your margins right there. So I would focus on deals that are at least 3 to 5 years out that will get us past this economic uncertainty, deals that are relatively stable and conservative over that 3 to 5 years, so that if we see, for some reason, increase in interest rates or a tightening in lending or a drop in rents or an increase in vacancies, that it can weather that storm. Basically, that's the takeaway here. Anything you're going to invest in right now, make sure it can weather a 3 to 5 year storm, because as we all know, 5-10 year time horizon, real estate's always going to do well. You just need to make sure that you don't get crushed in that 3 to 5 years while you're waiting for things to improve.
Well, that is a great transition to my last question. It would not be a real estate podcast at all without mentioning bridge debt. It is becoming, coming back and maybe a little bit more popular now. And we're in an environment where possibly interest rates might start coming down, which is a better time to do bridge debt than when it's going to go up like a rocket ship. So how do you feel about deals that you see that with all those qualifications you just mentioned, but then they have bridge debt because you said you want to avoid the short term? Now, bridge debt is usually like 2 or 3 years. So it seems like you're saying maybe steer away from the bridge debt.
It's a tough question. And here's kind of my nuanced answer on that. If I'm buying something where the risk is solely on me, I don't have investors, maybe I have a couple close partners and we're all kind of sharing in the risk. We don't have a bunch of passive investors, LPs. I'm pretty good with bridge debt. I actually think bridge debt is a relatively safe bet right now. The problem is bridge debt has some catastrophic risks. It's kind of like 95% of the time, bridge debt, I'm just making these numbers up, 95% of the time, bridge debt's going to be just fine in this environment. The problem is 5% of the time, you run the risk of losing your entire investment. And what that looks like is you get 3-year bridge debt, and over the next 3 years, we see an economic contraction, we see lending tighten tremendously, we see values go down. Your bridge debt gets us 3 years into the future, and now you need to refinance out of that debt. And the lender says, hey, I need you out of this debt. I'm not going to let you extend it. What do you do if your values have dropped, if rates have gone up, which I don't think they will, but they could, if lending is tightened up and lenders are saying, we're just not lending as much these days? You're now stuck in a position where you can't really refinance with bringing a bunch of capital to the table, and that's a catastrophic risk. And so I guess my short answer is I'm comfortable with bridge debt, but you just need to make sure that if you have other investors out there who are relying on you to manage your risk, that there is catastrophic risk with bridge debt. We saw this back in 2020, 2021. A lot of operators right now got caught with their pants down because they didn't expect interest rates to go up as high as they did. They didn't expect values to falter like they did. And now they're in this weird place where a lot of operators are losing deals or getting crunched because they had bridge debt and the market moved against them. That's a risk. And so make sure you have a mitigation plan or you're willing to accept that risk.
And one last question I have to throw in here, and then we'll close out, is, the beige book, which is the what the Fed comes out with periodically, the last one that came out, I think it broke a record. It said the word uncertainty 45 times, which is a record. They've never said it that many times. And now with the tariffs, I think we've just added even more. So the next time we're probably going to shoot for 100 uncertainties in there. So how do people deal with the next period of time with this administration? There's a lot of uncertainty on a lot of things. How do investors deal with that? Or what are some ways we can deal with that?
Don't make big bets right now. That's kind of mine, unless obviously you're a gambler, because things can swing in big ways either direction. We could see the tariffs be lifted tomorrow, in which case we would probably see the market spring back and hit all-time highs because there's so much exuberance out there. There's still a ton of money out there. At the same time, we could see the administration double down on tariffs. We could see a bigger trade war break out, and we could see a major recession hit. A year or two ago, I would have said, I think we're kind of in a holding pattern for a while. I don't think the economy is going to go up much. I don't think the economy is going to go down much. I don't think it's going to get much better or much worse. That was the time to kind of make bigger bets because there wasn't a ton of risk. I think now is just the opposite. I think we could see major swings. I don't know which direction they might come, but either direction. So I'm kind of avoiding any big bets right now. I'm being conservative. In baseball parlance, I'm playing small ball.
That makes sense. Well, thank you very much, Jay. This was fantastic. And to our audience, if you didn't get enough of Jay, which I never have enough of Jay, come see us in Columbus, Ohio at the PassivePockets conference on May 2nd, May 3rd. Jay will be there and he'll be one of the speakers. So we're really excited about that. But Jay, thank you for jumping on short notice. This was a fantastic chat about tariffs. So thank you very much.
Thanks, Jim.
That wraps up our deep dive into the Liberation Day tariffs and today's economic landscape. Big thanks to Jay Scott for sharing his analysis and giving us so much to think about. If you found this episode helpful, be sure to like, subscribe, and leave a comment. For more tools and education to guide your investing journey, visit PassivePockets.com and check out our 7-day free trial. Thanks for tuning in, and until next time, stay informed and happy investing.